Yeah.
So the problem with the asset purchase is you got to go out and get an assignment of every contract that says, you can't assign this contract without our permission.
Hmm.
And most contracts will have that anti-assignment provision. Not all of them will have a change in control provision, but you know, the vast majority of contracts will allow for the stock to be purchased and not to have an assignment.
Folks, it is a privilege to be sitting down today with Thomas Fafinski at Virtus Law to talk about legal topics MSPs should be thinking about when looking to sell. Virtus Law was founded in 2010 and is a nationally recognized firm that focuses on the MSP space. Thomas and his partner work regularly on MSP transactions and are a common fixture at MSP conferences and at MSP peer groups, speaking and advising MSP owners on the legal issues that keep them up at night. Listen in here and follow Thomas at www.virtuslaw.com. But first, before we go any further, let's get some housekeeping out of the way. My name is Madhur Duggar. I work in the IT and software M&A space, and this is my podcast series, M&A Insights. If you are interested in having a conversation around the strategic direction of your firm, are looking to grow your book and want some marketing and business development help, or are an investor looking to make an acquisition in the space, write to me at podcastwithmadhur, that's MADHUR, @gmail.com, or reach out to me on LinkedIn. So, what are the first legal steps an MSP owner should take when preparing their business for a sale?
Well, from a timing perspective, you should probably, you wouldn't be making a mistake by planning 5 or more years out. There is a tax phenomenon when you're a C corp for 5 years. You have the ability to sell your business for up to $10 million or 10 times your basis and have no taxes. So you narrow the market of people that are your prospective buyers, because they got to have to want to buy the stock of a C corp.
Mm-hmm.
So it might be more of a private equity, like I know I'm going to sell to private equity, or I know I'm going to sell to investors, or I know I'm going to go public type of thing. But if you want to have the sale be treated as income tax free, no capital gains, no income taxes, you really need to make that decision 5 years before you sell, because you have to be a C corp 4 or 5 tax years in order for that to work. So from a
Interesting.
timing perspective, you want to go back to that. So most people don't have that type of foresight. So the idea is, how can I structure this so that the business is appropriate for a sale? If you do an S corp structure, you end up having the ability to manage your income tax burden a little bit better through operations. You can
Okay.
reduce your income taxes, but it's also harder to sell. Not that much harder. We have to go through something called a tax-free reorganization in order to sell to, for instance, private equity. We'd have to probably do like an F-reorganization which increases the cost, but it's pretty common now, so it's not, terrible.
Okay.
What I like to do for those companies that say, I know that I'm going to sell in 3-4 years, probably 3 years, is I like to create a holding company. And so what happens is the operating company is, let's say it's an S corporation, the operating company sits below the holding company, and the operating company generates the 15% profit, and it distributes it to its parent, the holding company. So MSP HoldCo and MSP Inc. So MSP Inc. makes 150,000 in profits. It pushes it up to MSP HoldCo. MSP HoldCo then takes deductions that like I mentioned, bottom line
Yeah.
deductions. And so that makes it a little bit cleaner when you go to sell. Not that you won't have to share the financials of MSP Holdco, but when you share it, the buyer, when they're doing their Q of E, quality of earnings, they will realize how truly bottom line this is. Participation in peer groups, um, owner-based travel stuff, owner benefits that are being
Yeah.
drawn out. So some folks some people sitting in your seat say, "Hey, you're just gonna have to live with the taxes." And if you want to get real value for this, you have to live with those, and don't take those deductions that you ordinarily would, if it's not essential to the operation of MSP Inc.
Mm-hmm.
But you push it up to MSP Holdco and it
Mm-hmm.
works. You could
Mm-hmm.
also have an affiliate organization and pay a consulting fee.
Mm-hmm.
Um, in that setting, the consulting fee does impact your profit margin, and so
Mm-hmm.
I don't care for that solution. And I like it better when the subsidiary is a S corp in that structure, because then it's filing its own tax return. If the subsidiary is an LLC taxed as a partnership, then the income rolls up to the holdco, and then the holdco taxes are filed, and then you've got to supply the holdco taxes for sure in the eventual sale.
Thomas, what should we think about when it comes to the common legal structures that we see in MSP acquisitions? I mean, asset sales versus stock sales, as an example.
Yeah, so an asset sale is really favorable to a buyer because they can take the assets and depreciate them over time. Physical assets get treated differently than intangibles, and most of the MSP sale deals with an intangible. So, in other industries, there might be a lot of argument about allocating the purchase price. Normally, what we see is it's kind of migrated to, we're going to look at the closing balance sheet, the balance sheet of the seller on the date of closing, and we're going to adopt the categories that are set forth in the closing balance sheet in terms of the numbers that we're going to pick. And then there might be a way to change that if a mistake was made in the closing balance sheet later on. But um, otherwise, most of the value of an MSP is going to be attributed to goodwill and depreciated over 15
Yep.
years.
Yep.
So from a buyer's perspective, if they are a strategic buyer and they're borrowing to do this deal, and they're putting 25% down, so they're not using an SBA loan,
Mm-hmm.
um, and they have 75% that they want to write off over 15 years, they they have a 10-year term on their loan and 15 years to write this off. So they want to write off as much as they can to kind of offset the cash flow burden
Mm-hmm.
associated with repaying the debt with after-tax dollars, because
Mm-hmm.
that's what they're doing. They're taking operating income. They get to reduce the interest expense, but not the principal reduction.
Mm-hmm.
So from a buyer's perspective, it's really nice when you have that ability to do that. When you do a stock sale, it's very similar to if you and I go out in the market, we decide to buy stock in 3M. We
Mm-hmm.
buy it, say, for $100 a share. I don't even know if is that a realistic value? I don't even know.
I don't know what 3M trades at
Yeah,
anymore.
yeah. So let's say you go buy it, and you don't get to depreciate any part of that, nor
Yeah.
does the buyer in a securities. They assume they get to inherit the basis, but they don't get to write it off. So from a buyer's perspective, they always want to have the more tax favorable, not always, but almost always want to have the
Mm-hmm.
more tax favorable environment.
Yeah.
So, why would you pick one over the other?
Yeah.
So the problem with the asset purchase is you got to go out and get an assignment of every contract that says, you can't assign this contract without our permission.
Mm-hmm.
And most contracts will have that anti-assignment provision. Not all of them will have a change in control provision. So
Mm-hmm.
occasionally there will be, hey, if the ownership has changed and somebody else is in control, we get to consent to it, or we get to get out.
Mm-hmm. Mm-hmm.
But you know, um, the vast majority of contracts will allow for the stock to be purchased and not to have to have an assignment. So that's the real benefit to the stock sale. So there's this in-betweener thing, and we call them tax-free reorganizations, and I always call them F-reorgs. There's multiple ways that you can do it, but essentially what we're doing in an F-reorg is we are selling the stock. So let's say you owned MSP Inc. and you're selling the stock. Well, we actually want to insert a holding company in between you and MSP Inc. So we have MSP HoldCo, and then MSP HoldCo owns MSP Inc. MSP HoldCo is now going to sell the securities of the wholly owned subsidiary, and the EIN hasn't changed. But from a tax perspective, this IRS says we're going to treat that as though it's an asset purchase, right? And think about it: if you're the seller and you have to go get all these assignments, this is the way it looks. I'm the MSP and I'm trying to sell, and you're my client. Hey, Matter, I'm looking at selling my business to ABC Co, and I can't do that unless you assign. I know you don't know anything about ABC Co. And if you did know it, you probably said no to them for providing direct services to you to begin with. But I still want you to consent to this. And that's pre-close. So the whole world gets to find out.
Right.
So from a seller perspective, it's not a bad deal to do it. And also, the goodwill gets treated as capital gains from the seller's perspective. So it's really just the non-compete, the compensation for the non-compete, and the assets that are being sold where you're going to get taxed as ordinary income, like recapturing depreciation, that type of thing. So most sales, let's say it's a deal that's a $2 million deal, I might see $100,000 associated with tangible assets. So the seller is paying increased taxes on the tangible assets, but the buyer gets to write off over 15 years the full $2 million.
Let's talk a little bit about employee and contractor issues, especially when it comes to transferring things like employee benefits or pensions or stock options, right? What are some of the legal issues or implications of transferring employee benefits or pensions or stock options during a sale?
So if it's an F-reorg, where it's really, from a legal perspective, it's treated as a sale of securities. It's no different than when you and I buy stock in IBM. There is no transfer benefits or anything like that. It just happens. When it's a sale of assets, then out with the old and in with the new, if any. When it's an F-reorg, it's treated as though it's the sale of stock. So it's pretty seamless in an F-reorg. Really, I mean, F-reorg is really easy to keep it quiet. A lot of my clients don't whisper this to anybody inside their organization. And when they're doing the customer check-in calls, it's, normally it's couched in a customer satisfaction type of assessment that they're undergoing. But many times I've done it where even the key employees, the C-suite employees, other than the CEO, didn't even know it was being sold. So it's really easy to do that. Integration is a lot easier when, of course, you're buying IBM stock. The integration is just really simple, right? And the same is true in terms of a stock sale versus an asset purchase sale. It is a huge mess with an asset purchase to get everything all to come to fruition in a moment in time. And then there's a bunch of stuff that's left over hanging, and the parties are talking about what's going to happen if they say no, and let's assume that it is. And I've set up temporary operating arrangements where the seller MSP is staying open for business for these 3 clients, and it's agreeing to sub out all of its work to buyer in exchange. And it's almost like like a managed healthcare solution where
Hmm.
we're just paying just the cost associated with doing the customer management, and then everything else goes to the buyer. It's really a pain, but it
Yeah.
works.
Okay. Thomas, thank you so much for a really
Oh,
incredible conversation. I really
thank you for
appreciate it.
having me.
I think this was very, very useful. Insights on the legal side. I think my audience would really love to hear that. So I appreciate it. And yeah, I hope to stay in touch and maybe do another one of these in the not too distant future.
Sounds great. Thank
Yeah.
you, my friend.